Welcome to Modoras Financial Performance Solutions. Over 3 decades of experience, integrated service solutions, a wealth of financial intelligence, award-winning client care, one guiding vision, your lifestyle potential. What are the best strategies for saving tax? With the end of the financial year fast approaching, now is the best time to take action. Welcome to Get Ready with Smart End of Financial Year Strategies webinar. Today, our experts, Director Modoras Accounting, James Morris, and Associate Director and Executive Planner Tony Sarai, will share business tax tips, individual tax tips, superannuation tax tips, and other smart end of financial year strategies. We encourage you to submit your questions through the Q&A feature. At the end of the presentation, James and Tony will be making time to answer them. And James will be kicking off our session this morning. Over to you, James.
Thanks, Stella. My apologies for that, a few technical issues on my end. Look, as with all good seminars, we need to start it off with a general advice warning that we're talking about general terms today, and if some of the concepts relate to your specific business or situation, please feel free to contact us to talk about some specific advice in relation to your needs. So just bear in mind that what we're talking about today is a lot of general concepts that may or may not be appropriate to your business. So let's get underway and have a look at what we're going to cover today. Okay, so we're going to talk about some general business tips, then move on to some individual tax tips, and in amongst all that, since it's quite topical at the moment, we'll talk about some of the tax policies that are coming through from the major political parties, given that the election is this Saturday. Tony Sarai is going to talk to you about some superannuation tax tips, and then we're going to have he's also going to talk about some other smart end of financial year strategies. So moving right along, one of the major changes that has just recently happened or is just about to come into play is the single touch payroll. This is more of just a general knowledge, not necessarily a tax strategy, but basically with the single touch payroll, we just want to make clients aware of it, because probably this is one of the probably biggest tax changes to our biggest changes to our tax system probably since GST. It's the first step in what we would call the tax system going digital, and the whole thrust of it is the ATO is looking to get real-time information about wages paid to employees, about tax deducted from wages, and superannuation payable for employees. So basically, each time you do a pay, your computer systems will need to file with the ATO essentially the year-to-date wages, year-to-date tax, year-to-date super payable. The ATO that will then eventually pre-fill your BASs and your instalment activity statements. You won't need to issue payment summaries to employees. Employees will be able to get their wage information and tax information off the MyGov site. So it's quite a significant change in the way that we report wages and other information to the ATO, and it's probably the first step in what I call the sort of the big data. The ATO starting to look at big data, mining big data, getting real-time information. You know, one of the throw-offs of this is that super funds are also reporting super payments, and so the ATO has virtually got an on-time comparison about what's owed to an employee and what's been paid. So it's quite a big step in the technology, and it's probably going to move. Well, there'll be some significant moves over the next few years as this digital policy expands. Also, just wanted to touch on this superannuation SGC amnesty. It's a policy the Liberal government introduced, well, it would be May 2018. Unfortunately, the legislation never got through Parliament. The amnesty finishes on the so-called amnesty finishes on the 24th of May. quite a number of people have taken up the amnesty, where they've remitted amounts of super that they owed for prior superannuation guarantee liability. And as part of the amnesty, they had a reduced penalty. They still had to pay some interest in relation to the superannuation owing, and probably one of the big pluses was that they were going to be entitled to a tax deduction for the super and for the interest. The unfortunate thing is, without legislation, none of that happens. The ATO has no discretion to remit penalties, no discretion to allow a deduction, and so it's interesting to see how that one's going to pan out. And just a last point, the Labor government weren't in favour of the amnesty, so they're probably not going to do anyone any favours. So unfortunately, those people who took up the amnesty, there's still some unresolved questions as to where they're going to sit with their the amounts that they paid. I've got a feeling that they're not going to be entitled to the deduction, and hopefully they won't be levied any further penalties, but we'll wait and see on that. This is payments to workers. It's another interesting one that kicks off on 1st of July 2019, and it's more of something to be aware of. And essentially what it means is that if you have an obligation to deduct PAYG withholdings from a payment, now that could be a payment of wages, it could be a payment to a labour-only contractor, but if you've got an obligation to deduct tax and you don't, then you're not going to get a tax deduction for the payment. So it could be quite significant. And this will even push out into particularly business owners. You know, sometimes we have situations where business owners don't pay themselves a wage, and at the end of the year, a wage is established for them, but they might not have paid the tax on it. They put the wage in their personal return and then pay the tax in their personal return. Well, essentially, they won't be able to do that. They'll have to ensure that they've got the wage in the business and that they have appropriate PAYG withholdings from that wage. Otherwise, the business will not get a tax deduction for those wages. And so, again, you know, people who pay cash wages, people who aren't deducting the right amount of tax, this is going to bring a few people undone. So something to watch out for. The ATO are obviously going to have some audit process in this, and they're looking for people who are not meeting their obligations there. And just as another issue is looking at, I was supposed to go on to my comments from about big data, is that the ATO are increasing their audit activities. So if you're in a cash business or something of that nature, you've just got to be aware that the ATO have, I suppose, a lot of eyes out there. They have very close communication with a lot of government departments and non-governmental institutions, whether they be banks, super funds, those sort of things. A lot of benchmarking is being done by the ATO. They have, you know, if you think about, for example, just pick an industry, plumbers, for example, they would have hundreds of plumbers on their books, and they can compare industry standards quite easily. So they can look at specific businesses and they'll have a reasonably good field of data that they can look at benchmarking. So that's something that they're looking very closely at. And just we do actually, and one of the services we offer, we do actually have audit insurance if you feel that you're looking at some issues there. The cost for some audits, depending on what they are, can be quite significant, particularly if we've got to go and get additional legal advice on those. Okay, so let's start to look at some strategies for business, and probably one of the key strategies that the government has been pushing is this instant asset write-off. So it's gone through a number of changes. You'll note there that actually I'll even go back to I think 2012. I think it was $1,000. So this instant write-off has grown over the years, and now in 2020 we're moving up to $30,000. So it's an area where the government is seeing, well, you know, to get small business to promote spending and investment in their business, they bring in this instant asset write-off, and it has been successful to promote investment within business, and that's why they've continued with it. So basically, if your turnover is under $10 million, you can essentially get a deduction for up to $30,000 instant write-off, and that's the excluding GST price. So obviously that would be 30,000 plus GST would be the price of the product. The other area just to watch on there, if you are spending on equipment over 30,000, you still get quite a generous depreciation deduction through what we call the small business pool process, which essentially will give you a 15% deduction of the cost of the plant and equipment in year 1, and then 30% of the written down value in year 2, and so on. So that's a reasonably generous avenue for claiming your plant and equipment. Motor vehicles, just bear in mind that there is a limit on what you can claim depreciation on and what you can claim GST on. So 57,581 for the 2019 financial year is the maximum value that you can put a car, or I suppose claim depreciation on over the life of the car. And also 1/11 of that is the maximum GST that you can claim on a motor vehicle. So if you bought a BMW for 120,000, it's only 57,581 divided by 11 is the GST you can claim, not 1/11 of 120,000, and also the amount you depreciate is 57,581, not 120,000. So it's just something to bear in mind there. One of the other areas that the ATO are looking very closely at, and really I thought this was a long time coming, because you only have to drive down to the local boat ramp and you'll see a wide variety of business utilities turn up there on the weekend with boats and jet skis and such. And so the ATO are seriously looking at the FBT exemption on these types of vehicles. Now, as a general rule, if it's a utility or a van and it's not designed to carry passengers, so in other words, there are some utilities out there that are recreational vehicles as opposed to, and they're sold as recreational vehicles, not utilities. Basically the travel of these vehicles is just merely to and from work, used in the course of employment, and the non-business travel is minor, irregular, and infrequent. Now, so going down to the boat ramp on the weekend is not what the ATO consider to be minor, irregular, and infrequent, particularly if you're doing it every weekend. So what they've done is they've put some kilometres onto the rules. So they've said that if you're going from home to work, a deviation of more than 2 kilometres will be considered a private trip. So, you need to watch, still you can drop the kids off at school, but if you're deviating by more than 2 kilometres from your route to the job site, well, then there's issues. They've basically said you can have 1,000 kilometres private for the year, providing there is no trip greater than 200 kilometres. So in other words, the trip to Fraser Island might be off. So these are the sort of things that they're looking at, and the problem is with all of this is the only way to prove that you didn't travel privately is to keep a logbook. So this is sort of forcing utilities and things that you would normally have not kept any records on, you may now need to keep records on and keep a logbook to be able to show what your business travel has been. One of the other areas, and I mentioned that the ATO is getting smarter, or maybe taxpayers are getting a little sillier, but social media is a dead giveaway. If someone's got their ute, as I said, on Fraser Island, traveling around for 2 weeks, it's all on social media. Toll charges, if you've got a lot of toll charges happening on the weekend, there's a question mark there. If you don't have another personal vehicle, well, that's a big sort of question mark. And also non-business accessories attached to the vehicle. So, for example, if you've got your kayak racks or your surfboard racks on the roof, there might be a question mark there. Or if the vehicle is geared out with camping stuff and extra four-wheel driving stuff, there's a question mark on that. So it's an area that when we start to look at fringe benefits tax, we're going to have to be looking to ask clients to be more diligent about how they manage their utilities. Getting back to something more practical for an end of year tip is when looking at directors' fees or bonuses. You can actually resolve to pay a director's fee or a bonus this financial year, but not actually physically pay the cash until next financial year. So from the business's point of view, they've declared and created a liability and can claim a tax deduction in this current financial year. But because the payment wasn't actually paid to the individual until the following year, it doesn't go into their income until next year. So it's sort of a process of bringing a deduction forward into this year. So that's something that can be used with good effect. Also, the delay of income. I always have a question mark on this one, in that I think working capital needs to be considered first. So you know, you're not going to delay invoicing for a month just to push things into next financial year, because you've got to maintain a reasonable cash flow of money into your business. So you know, you could do some massaging here to get a better tax outcome. Also, if you're on a cash basis, I generally recommend most people to pay all their creditors and such before the end of the year, so that we can claim that as a deduction as well. Company tax rates is an area where there's some movement. I mean, the current tax rate for companies under 50 million or less is 27.5%, which, when compared with a lot of the marginal tax rates for individuals, is actually quite a generous rate. And again, we've got proposed to drop there to 25. I think, from what I understand, there's going to be some question marks on that, subject to what happens on Saturday. So we also look at a couple of other ideas here, which I mentioned before when we talked about directors' fees. You can also look at prepayments, and you can prepay expenditure, which is all about taking something that you were going to spend next year and bringing it into this year. So in other words, it might, you know, you can prepay things like a rent, maybe some lease payments, maybe purchase or service your equipment this side of 30 June instead of other side of 30 June. Tony's going to talk a little bit about superannuation contributions, but one thing I'd like to raise there is that super contributions are deductible when they're paid, not when they're accrued. So for example, your employees' super that's due for the June quarter, if you can pay that before the end of June, you can get a deduction in this year. And also, if you're making top-up contributions to the $25,000 concessional limit, you'd look at to do that before 30 June. So part of the tax planning would be to pull expenditure from next year into this year, or push income from this year into next year. You could also look, because of the tax advantage of the 27.5%, you could look at introducing also a corporate beneficiary into some of the tax discretionary tax distributions. Some of this, depending on the type of company, the type of business, this also has a question mark as to whether it'll be 30%, because there's two company tax rates that float around, 27.5% and 30%, and it does depend on the type of income that the company ultimately receives will dictate which tax rate it will pay. For a straight corporate beneficiary, it's probably most likely going to get caught on the 30%. But again, that still can be a favourable tax outcome than, for example, the highest marginal tax rate. I'll talk about some election things very shortly, but one of the ones I'll just mention here is that obviously the Labor Party policy is to remove the refund of unused franking credits, and also they are talking about putting a 30% tax on discretionary trusts. I haven't seen a lot of information on that, but essentially that would act as or put trust very much in the same category as companies. I would expect that the income that the trust pays tax on, that tax will be very similar to franking credits, and will get passed on to the beneficiary, and then the beneficiary will be able to use those tax paid by the trust as credits, but I don't think they'll be refundable credits. So if you don't use them, I think they will be lost. So that's something that's, again, going to be or that we'll see a little bit more information on in future. But as part of that process also, we need to be looking at making these trust distribution minutes before 30 June. Pretty much all trustees require the trustee to make an election before the 30th of June as to how they're going to distribute the income for the current financial year. So that's part of our systems over the next month or so. We'll be sending out to our clients our recommendations on trust distributions and then getting their feedback as to get the best tax outcome in regards to those trust distributions. Okay, moving on to some things for individuals, and the big thing for individuals is always substantiation. The ATO have some fairly clear rules on substantiation for employees, and we just need to make sure that, particularly when it comes to things like internet usage at home, or maybe home office, or maybe use of a mobile phone as such, the ATO are looking for at least a month's worth of diary entries, or at least a month's worth of analysis on a telephone statement or something like that to get the appropriate percentage that they're going to apply. Motor vehicles is generally a common area where that people look at, and there's generally two methods these days in regards to that. There's the cents per kilometre method up to 5,000 kilometres, which is generally based around a reasonable estimate for the amount of kilometres you've travelled. And the other option is the logbook method, where there's no limit, but you've got to be able to substantiate not only your motor vehicle expenses, but also have the logbook for 12 weeks. That's 12 consecutive weeks. The cents per K rate has been increased from 66 to 68 cents. And again, it's a reasonable estimate, but, and again, I often caution people in saying that, you know, even though it's a reasonable estimate where you can just make a few notes on paper, whatever it might be, it's always still good to come back to some sort of logbook, some sort of good record of what your kilometres were that you travelled. As I've mentioned there, you know, make sure you keep your receipts, your invoices for all your running costs. Generally, the travel to and from work is private. However, there are some exceptions where you're transporting bulky equipment. Bulky equipment, the ATO, and I must confess, I don't have to have it off the top of my head, but they have a level of weight and a level of size that they would look at in order to allow that one. So it has to be more than your lunchbox, basically. Traveling to abnormal workplaces, and also where home is your place of work. Home office deduction, again, it's one of these things that we look at, and we essentially need, or what you need to be able to claim is an area wholly and exclusively set aside for your work, and some sort of record that you've maintained or worked at this office for a period of time. And you can, the simplest way of claiming that deduction is, again, very similar to the kilometre cents per kilometre. It's 52 cents per hour. And so you need to look at that and keep a diary record of what hours you've worked from home in order to substantiate that. Tools and equipment. So generally there's 100% deduction on anything up to 300, and anything over 300 is generally based on what we call reasonable life. Some power tools, for example, you might write off over 2 years. So while you're not getting 100%, it's a fairly quick write-off. Anything that is used both business and private, and classic example would be, you know, a PC or a laptop, you need to have some apportionment between the business and private use. And again, that would require some sort of log. If you're getting audited by the ATO, you would have to be able to produce some sort of a log. Excuse me. Rental properties. One of the areas where we still see a lot of people not claiming is depreciation of plant and equipment and the building write-off, which is the write-off of the original construction costs. Generally, that is written off over 40 years. So in some cases, a lot of properties are now reaching the 40-year mark, and so there might not be much there. But generally, what we do is we can engage what we call a quantity surveyor to go out and do a report, and they will advise us, you know, what the original construction costs were, and we can then work out the building write-off deduction from there. Depreciation in those circumstances have changed slightly these days, in that you can only really claim a deduction for depreciation on equipment or furniture that you actually purchased. So the good old days of when, you know, we could have had a stove in a house over 10 years through 3 or 4 different owners, and every time they did a quantity surveyor's report, the stove would turn up on the quantity surveyor's report for, you know, $200, $300, $400. The stove would get written off probably 3 or 4 times, and it just was not. While it was within the rules, it was just a bad outcome in relation to the way the law was. And so the ATO recently changed that and said, well, look, if there's a stove in the building, we ignore that. If you buy a new stove, well, you can start depreciating the new stove, but you don't depreciate the old stove. Also, last year, just to remind everyone, the travel to your rental property was removed. We still get quite a few inquiries about claiming their travel. Prepayments also apply to individuals, so you can actually prepay some membership subscriptions, buy tools, that sort of thing, just in the same way as a business can. Also, where an employee makes a personal concessional contribution, they're able to claim that as a tax deduction, whereas if my memory serves me right, that rule changed on the 1st of July 17, I think. Yeah, 17. So now the employee can make personal contributions and claim those tax deduction. But just bear in mind that the $25,000 maximum cap is made up of any contributions made by your employer, your compulsory 9.5%, and any other top-up payments that your employer makes, together with whatever personal concessional contributions you might make. So you might need to just keep an eye on that limit. And also, if you are claiming or intend to claim a deduction for personal contributions, you need to advise the superannuation fund and ensure that you get acknowledgement from the fund that they're aware that you're treating them as deductible contributions. One of the areas where high income earners will find a little pain as well is that I think the Labor Party is looking to lower this cap to $200,000. But essentially, if you're a high income earner earning over $250,000, and that's income including superannuation contributions, so your tax, what they call your adjusted income, you also face an additional 15% tax on those contributions in excess of the $250,000. Superannuation co-contribution, government will contribute up to a maximum of $500 where you've got non-concessional super contributions are made. That's also worthwhile looking at. Superannuation contributions for spouse, personal rebate of $450 when contributing $3,000 to, that's non-deductible contributions to a spouse super. And we can also look at maximising superannuation, or whether it be superannuation or other fringe benefits through salary sacrifice, particularly when you're dealing or employed by a public benevolent institution or a charity as such. And then you've also got a limit of 17,000 on not-for-profit hospitals and ambulance and public hospitals. So they're certainly part of the tax strategies for when you're working for those areas or employers that have tax concessions. One of the other things I might just go through before I flip over to Tony would be just to have a quick chat about some of the policies that are looking to be, or that the Labor Party is looking to bring in, and then we'll have a look at the coalition. But very quickly, we've talked about the dividend franking credits. The Labor Party are looking to move to a point where there are no refunds of franking credits not used, but you still get to use those, what available franking credits you have, to offset against tax that you pay on other income. It's just that any excess that you don't use, you're not going to get a refund of. Negative gearing, they're looking at basically putting a restriction on negative gearing so that you can't offset your losses against salary and wages income, but this will only affect properties purchased after January 2020. They're also looking at reducing the general discount on capital gains from 50% to 25%. As I mentioned before, the 30% tax on trusts. They're looking to limit, and I'm not sure about this, how this one ever came up, but they're looking to limit tax agent fees for individuals to $3,000. So there must be some expensive tax returns out there. They're going to focus a little bit on the multinational tax avoidance. They're going to be looking at some of the super concessions that we have. For example, non-concessional contributions. They're going to reduce the limit from 100K, 100,000 down to 75,000. I mentioned before about the super, the extra super on high income earners limit coming down from 250 to 200. And currently there is a, with the $25,000 concessional cap, there's a catch-up process that works. So if, for example, 1 year you use 20,000, you can carry that 5,000 over to the next year and claim 30,000 in the next year. Labor Party are looking to remove that. Tax cuts, look, even I get confused on who's doing what with tax. Bottom line is the Labor Party are looking to remove the tax reductions in 2022 and 2024, but giving tax cuts over the next 10 years. They're looking to bring in a temporary budget levy, which sounds more like a permanent budget levy of 2% on taxable incomes over 180,000. And they're also talking about increasing the low and middle income tax rebates. The coalition, on the other hand, hasn't had a lot of tax policies in their lead up to the election. They also have the low and middle income tax rebate that they're looking to change. The tax cuts that they've announced previously in the budget, which was to basically lift the 19% tax bracket from 37,000 to 45,000, and then in 2024 they were looking to remove the 32 or reduce the 32.5% bracket down to 30% and eliminate the 37% bracket. So basically what that would mean that from 45,000 to 200,000 you would pay 30% on that income. As we've previously talked, they've both talked about the instant asset write-off. Part of the coalition one was to lift that to 30,000, which we've already talked about, and Labor has indicated that they would do the same, but Labor has also indicated that they would make it a permanent thing, whereas the coalition's plan is due to finish by 2020. So yeah, Labor's looking to make that a permanent fixture, whereas coalition's plan currently, it would run out on 30 June 2020. So that's all I have in regards to the tax side of things, and what I'll now pass over to Tony to have a chat about the super side of things.
Thank you very much, James. And I think that was well covered in relation to the tax and the superannuation. So I'll once again start with just a general advice warning in terms of the tips that we're giving out today. It is for general information only. Certainly for personal advice, please seek advice from your Modoras advisor. Super tips. So, as James spoke about the tax advantages of saving within super, saving more in super can come with tax and other benefits this financial year, but that's just the start. Once money is invested in superannuation, earnings are taxed at a maximum rate of 15% instead of your marginal tax rate, which may be up to 47%, including Medicare levy. So this low tax rate can help build savings up for retirement, and is certainly a very good place to be looking at saving for retirement. There, I'll talk a little bit about the political side as well, especially with the budget that came out last month, where there was talk that from the coalition side that if you're over the age of 65, that contributions to superannuation can continue. That certainly, if the coalition were to get in and they were able to pass that, that would be certainly a benefit. Labor, as you heard from James, won't be going down that path. So strategy number one, so consider adding to your superannuation and getting a tax deduction. So this is what James was talking about in relation to you have a set amount of $25,000 as a concessional contribution, including your SGC that you are allowed to pop into superannuation for those under the age of 65. Over the age of 65, you must meet the work test in the current environment. And we do have those catch-up provisions, as James was saying. So if in the last year you only put in $15,000 into superannuation, including what your employer put in, this year you can put in 25 plus the other 10 that you didn't put in last year. So that certainly is a benefit for savings. It allows you to pay less income tax in this financial year and increases your retirement savings. Tip number two, get more from your salary or bonus and minimize the tax payable. So this may be right for those who are an employee where you contribute pre-tax salary or a bonus into superannuation as part of a salary sacrifice agreement. Now, as part of a bonus, it's something that must be agreed with the employer beforehand. But what are the benefits? Once again, you pay less tax, income tax, and that's at 15%, increased retirement savings as well. So that's certainly a benefit. Strategy number three, convert your savings into super savings. So this may be right for those who have money outside of superannuation, using this strategy by making an after-tax super contribution. So this is for those that have already paid tax on the money on the outside and want to make a non-concessional contribution into superannuation. As James was saying earlier, where if Labor do get in, then there will certainly be, and they do pass a law, they are looking to reduce the non-concessional cap from $100,000 on a per annum basis down to $75,000. One thing to, and I do have this further on as well, but I'll talk about this now. One thing to be aware of is obviously cash flow, and this is both from an individual and employer perspective, that only put into superannuation money that you can afford to put in and be without, especially if your time horizon doesn't allow you to access that superannuation. Strategy number four, get a super top up from the government. So this may be right for those who earn less than the $52,697 per annum. And this is by making the co-contribution. And many years ago, it used to be where you put in $1,000 and the government would put in $1,500. That has now changed where receive a government co-contribution of up to a maximum of $500 by you putting in $1,000. And that taps out at $52,697 per annum. So whether it be for yourself, partner, spouse, that may not be earning an income up to $52,000, it's certainly worthwhile getting a top up of $500. Boost the spouse's super and reduce tax. So this may be right for those whose spouse earn less than $40,000 per annum. So this is, as James was saying earlier, in relation to a spouse contribution. Use this strategy by making an after-tax super contribution to the spouse's super account, and this is up to a maximum of $3,000. So if you put in $3,000 into superannuation, you'll receive a tax offset of $540, and that tax offset is certainly a better outcome than a tax deduction, because a tax offset comes off the amount of tax that you are down to pay. Also, the other benefit is that it increases the spouse's retirement savings at the same time. Super tips and traps. So before adding to super, keep in mind money will be inaccessible until certain conditions are met. There are caps on how much you can be contributed to super each year, and it's important to take the caps into account, as penalties may apply if exceeded, and certainly those penalties can be extremely harsh, anywhere up to 93%. So make sure any contributions are received before June 30, and with electronic transfers, including BPay, the contribution takes effect the day the super fund receives the money, not the day of the transfer. It's important to certainly get advice, and as you can appreciate from what both James and I have covered today, it is certainly not an easy area to be on top of. So certainly getting advice is important. Other eligibility criteria and conditions apply in relation to these strategies. So talk to a Modoras planner or a Modoras accountant, whether you be in Victoria, New South Wales or Queensland, and we can certainly help you decide which strategies are more appropriate for you. And a few other things: prepaying income protection premiums for immediate tax benefits. So this is something where you can prepay the next 12 months worth of your income protection payments and claim that as a tax deduction this financial year. And how does prepaying for tax purpose work? The premiums paid on income protection insurance are often tax deductible if held outside of superannuation. Income protection insurance policies held through super funds may also be tax deductible for those self-employed, but prepaying a number of premiums in advance can increase the deductible amount claimable in this financial year. But certainly get advice from your Modoras planner and accountant in relation to that. And obviously you may be aware of prepaying investment debt and claim the payments this financial year. And that is certainly in the case of whether it be via investment debt for interest-only loans, as an example, or whether it be margin loans or the sort. Certainly advantageous to prepay those and claim those in this financial year. However, please note that if you prepay in this year and you do not prepay next year, then next year you will miss out on that tax deduction. So once you start, it's important to keep that going. However, if you believe cash flow is going to be a little bit up and down, it may be better that you don't prepay it and you just keep it on an ongoing basis and claim it as you go. Questions? Do you have any questions? Remember that the cost of tax advice is deductible for now, and if you do have any questions, you can please send those through via the chat function here. Alternatively, you can pop us an email and we will come back to you. Alternatively, more than happy to make a time to sit down and go through this presentation with you with a Modoras accountant or a Modoras wealth planner. And our gift to you: with professional advice, your lifestyle potential is just the beginning. So You're invited. Upcoming events, we've got the Beyond the Noise events coming up. A no-nonsense assault on popular investment wisdom. Sydney is on Tuesday, and I believe that we are extremely close to selling out. So I think at most we have got one table or two tables left at that. Gold Coast on Monday the 3rd of June and Brisbane on Tuesday the 4th of June. You can register at www.modoras.com/event/beyond the noise. Jump onto the website and have a look around. These events are not to be missed. And finally, thank you. So if you do have any questions or for more information, please contact us on the 1300 888 803 number, or visit us on www.modoras.com.
I think that's it for end of financial year webinar, our tax strategies. Thank you very much, James, and thank you very much, Tony, and most especially thank you all for your attention today. Keep an eye on your email. We'll be in touch soon. Have a good day, everyone. Bye-bye.